If rates cut in 2026, who gains leverage and who doesn't? Everyone is waiting for cuts, waiting for the announcement, waiting for relief, waiting for something to unlock. And the assumption underneath that waiting is simple. If rates drop, housing fixes itself. Buyers return. Prices stabilize. Sellers regain leverage. But that's not how this works. Rate cuts do not fix housing. They redistribute leverage. Because when the cost of capital changes, it does not affect everybody equally. It amplifies positioning. It exposes fragility, and it accelerates whoever is already prepared. So, today I want to model this properly. Not predict the Fed, not chase headlines, but walk through what actually happens if rates ease in 2026. And more importantly, who benefits first? So, what actually changes when people talk about rate cuts? They talk about mortgage rates. But the Fed does not directly set mortgage rates. Bond markets matter. Inflation expectations matter. Forward guidance matters. Markets move before headlines. If traders expect cuts, mortgage rates often adjust ahead of that, that announcement. If inflation surprises, rates can rise even while cuts are being discussed. So the announcement itself is rarely the turning point. Expectations are. Now, think about what that means if markets have already priced in modest cuts. Then the actual event may not create explosive movement because sophisticated capital anticipated it. What changes when rates fall by 1%? Monthly payments decline slightly. Qualification thresholds adjust modestly. Debt servicing pressure eases. But insurance volatility remains. Property taxes remain. Maintenance costs remain. A 1% move does not reset structural expenses. It eases friction, and easing friction benefits those who are already stable, not those who are already strained. Relief is not the same as opportunity. The wealth effect. There is another layer people ignore. The wealth effect. When equity markets rise, people feel wealthier, even before they sell anything at all. Retirement accounts grow, stock compensation stabilizes, bonus pools expand, and confidence increases. Housing follows confidence. It does not lead it. If equities rally into rate cuts, liquidity expands. Higher income households begin to relocate, some upgrade, some diversify. But if equities stall, even with rate cuts, confidence hesitates. And housing hesitates with it. So we cannot talk about rates in isolation. We have to talk about balance sheets, and psychology together. Sorry, I'm still getting my throat back here. But there's a narrative right now, though, that's large. Large investors are buying everything. That institutions are distorting the market. That narrative is incomplete. Institutional capital is selective, aggressively selective. They model yield. They model durability. They model tenant stability. They model infrastructure and proximity. They do not chase headlines. They chase durability. So when rates ease, their cost of capital shifts as well. But they still filter aggressively. They're not absorbing fragile inventory. They are not chasing risk-exposed properties. That means you can have institutional activity rising while weaker inventory still stalls at the same time. 2 markets, 1 geography. Different balance sheets. If this kind of structural breakdown is helpful, and you prefer analysis over headlines, make sure you're subscribed, because we're going to be keeping this up. We're going to keep building this framework layer by layer. Let's use South Florida as a case study. Let's narrow this in. South Florida is not one market. It's a series of filters. Palm Beach County does not behave like every part of the state. Boca corridors do not behave like inland. Selective Miami areas do not behave like older condo clusters. If rates drop modestly, capital corridors accelerate first. Luxury stabilizes faster. Prime school zones tighten. Newer construction absorbs steadily. But insurance, sensitive inventory, does not magically recover. Older buildings with reserve scrutiny still face hesitation. Underwriting still matters. Flood exposure still matters. Rate relief does not erase structural risk. It rewards structural strength. And here's something people underestimate, I believe. High income relocation does not happen because of, spreadsheets alone. It happens because the family approves of the ecosystem. Schools, healthcare, community, safety, lifestyle durability. Capital does not relocate permanently without alignment at the home. So if you're evaluating South Florida specifically, and you want a strategic conversation about positioning, not just listings, my contact information is below. I take a limited number of serious conversations because I believe clarity matters more than volume. Now, let's talk honestly. If you are payment sensitive, a rate drop helps. It reduces strain, but it does not create unlimited access. Prices in strong corridors may firm. Competition may return selectively. Insurance volatility may still filter options. Relief reduces pressure. Opportunity requires positioning. Sorry, I have to keep doing this. Throat. Let's model this scenario. Scenario 1. Soft landing. Modest cuts. Equities stabilize. Luxury accelerates. Capital redeploys selectively. Mid-tier firms gradually. Scenario 2. Cuts plus equity rally. Confidence expands quickly. Second home markets tighten. Capital corridors move faster. Scenario 3. Cuts arrive with economic strain. Confidence remains cautious. Liquidity waits. Risk exposed inventory reprices. In all three scenarios, stratification remains. Rate cuts change speed. They do not eliminate structure. If you see something I should be modeling differently, or you're tracking a corridor I haven't mentioned maybe, drop it below. I genuinely value intelligent pushback. That's how framework gets stronger. So, rate cuts are not salvation. They are accelerants. And accelerants amplify what already exists. Strong balance sheets gain optionality. Fragile positioning fills temporary relief. Liquidity moves first. Leverage follows. Confidence. If this gave you perspective, like the video, some more serious viewers find it. Subscribe if you want deeper structural housing analysis. And if you're looking at South Florida through a strategic lens, my information is below. We can talk through positioning. Clarity compounds.